Hi, Attorney Bill Bronchick here, and I'd like to talk to you about five different types of loans you do not want to take subject to the existing mortgage on. Now, just to review, taking subject to means buying a property, getting a deed to the property from the seller, and not assuming and not paying off the existing loan, but just continuing to pay the loan as if you were the seller. The loan remains in the seller's name, and you are not personally liable. Now, most big banks could care less if you took their property subject to and it was Bank of America or some other big outfit like that. They probably would not care as long as the payments get made. However, there's five categories of loans that I would definitely recommend you stay away from for risk of the loan being called due. And here they are. Number one, a small local commercial bank or credit union loan. So if it's a local bank that has a half a dozen branches, they probably collect the payments and service it. They know what's going on, and they will probably catch the transfer or a different name on the check, or most likely a change of insurance because when the property transfers from seller to buyer, you need to change the insurance to name the buyer you, and then the bank gets a copy and they will probably make a stink. So I would stay away from those. Number two, a private loan or a seller carry loan. So if the seller bought it from somebody else with a seller carry loan from an individual, or bought the property with a private loan from a private individual, that is the same type of issue. They're going to know what's going on, and they're probably going to make a stink about the fact that you took over the property without assuming and without paying off the existing loan. Number three, a state sponsored down payment assistance program in conjunction with an FHA loan. Now, in general, FHA loans are not a problem, but there are many state agencies that will give down payment assistance to a low income borrower to pay the 3.5% down for the FHA loan, and they'll usually put a second lien against the property behind the FHA loan. And in most cases, they will call that loan due. So make sure if you see if it's an FHA loan, make sure there's no down payment assistance, second lien against the property when you do a title search. Number four, a reverse mortgage. A reverse mortgage is due not just when the seller transfers the property, but even if the seller moves out of the property, as in moving to an old folks' home, it is due at that point. Now, in the short term, it takes them almost a year to call it due. In the short term, if you wanted to buy subject to fix and flip it, that's fine, but you can't keep that loan out there forever. And finally, number five, if you've got a seller who had a property deeded to them in a divorce from the other spouse, and there's a court order that that property, when it's sold or refinanced, pays off the other spouse who deeded it over. I wouldn't do that subject to because it's going to trigger that requirement, and you're going to get pulled into a court proceeding involving that divorce issue. So there are a few others that I wouldn't take subject to, but those are the five main categories that I would stay away from. Stick to conventional FHA, VA loans that are big outfits, big mortgage companies that use outside servicers and so forth. And for the most part, you're going to have a pretty low risk of a lender calling that loan due.